Hi, hello, good evening. Welcome back to the TCS Academy for Competition. So, today in this session, I will take you through the very important concept in economics, especially the banking sector. So, we have a Basel norms, right? Under the Basel norms, so there is a concept called bank's capital. Okay, bank's capital. So this is the particular topic. So let me take you through this particular topic. Let's understand in detail about the concept. What is the capital of a bank? Right? Okay. So let's begin the session. Yeah. Basically, the bank has two types of capital, right? Basically, the bank has two types of capital: tier 1 capital and tier 2 capital. Tier 1 capital, which is more secured capital. Tier 2 capital is less secured. Clear? Bank has certain capital, certain capital assets, right? So as far as bank is concerned, the bank or the banker has two types of assets, two types of capital. One is tier 1 capital and tier 2 capital. What is tier 1 capital? What are the components which comes under tier 1 capital? As I mentioned, it is more secured capital, tier 1 capital. It includes equity capital, retained earnings, preference shareholders capital. Okay, tier 1 capital. Components of the tier 1 capital: number 1 is equity capital, retained earnings, preference shareholders capital. Is that clear? On the other hand, we have a tier 2 capital, which the components of this tier 2 capital we consider as a less secured capital. Okay, what are the components comes under tier 2 capital? Subordinate debt, revaluation reserves, undisclosed reserves. Clear? Under the tier 2 capital, it is the less secured capital. In that we have three components. One is subordinate debt, revaluation reserves, and undisclosed reserves. So dear friends, let me take you through this particular topic. Let's understand this particular concept in complete. Okay, let's understand this particular concept in detail. Now, what is tier 1 capital? Tier 1 capital is considered as banker's core capital because it is paid up capital or equity capital. This particular, the capital, it is disclosed, which is appeared on the banker's financial statement. So that is why this particular component of the tier 1 capital so is considered as disclosed reserves. As I mentioned, it is a more secured capital. Is that clear? Let's understand what are the three components which we come across under the tier 1 capital, right? One is equity. Okay, you know very well. A banking company has been started. XYZ banking company has been started. Initial capital that has been put by 5 members. Okay, 5 members, 5 equity shareholders, right? 5 equity shareholders put their capital and established XYZ banking company. So it is some 5 crores, right? 5 crores, 5 crores, 5 crores, right? This particular 5 crores capital, which we call it as equity capital, that is, this 5 crores capital is considered as a owner's capital. It is also, we call it as core capital, okay. It is also called as equity capital, paid up capital. Is that clear? Okay. Let's move on to understand another important the concept or component which comes under the tier 1 capital, right? That is what we call retained earnings. Okay. What is retained earnings? That portion of earnings, that means the profit earned by a bank that is not disclosed to the shareholders, because that is not distributed among the shareholders. Okay. So whatever the profit earned in the banking operations, this particular XYZ company, banking company, as suppose the banking company has earned some 500 crores profit, right? This particular 500 crores profit, it has to be distributed among the equity shareholders. How many equity shareholders are here? 5 owners of the company. So they are distributing this particular profit, 500 crores profit, among themselves as per their contributions. Is that clear? Okay. But here, what is retained earnings? The earnings of the bank, that portion of earnings of the bank, okay, that portion of a profit of a bank that is not distributed to the shareholders this year as dividend, because the bank has some financial issues. So that is the reason why the bank is not able to distribute this 500 crores rupees among the 5 equity shareholders. It has to be retained. It has to be retained with the bank itself. It can be reinvested in the business operations, and it can be spent towards the working capital requirement, or this particular 500 crores is not distributed in one financial year, because the financial crunch, the bank comes under the financial problem. The 500 crores of money, whatever the profit earned, it is not distributed this particular year, which can be used to purchase certain fixed assets and expansion of the bank and reinvested in the banking operations. So that money, we call it as retained earnings. Am I clear to you, all of you? Okay. But don't forget, it is an obligation. It is an obligation of a banker. It can also be used for paying off any kind of debt obligations. Okay. Suppose the banker has some 300 crores debt to other outside creditors. Okay. This particular 300 crores, the bank has a debt. It has to be repaid. Okay. For this purpose, this 500 crores can be utilized to repay the debt, whatever the debt taken by the banker. It is an obligation of the banker, and it can be used out of 500 crores. Out of 500 crores, 300 crores of rupees has been paid off towards the debt obligations of the bank. Clear? Remaining 200 crores money has been reinvested in the business banking operations and expand the business, expand some branches. Okay. For that purpose, the banker can be utilized the particular 500 crores of money. 500 crores of money it is a profit. It is a profit in one financial year. Clear? Yeah. One more important component that we have in the tier 1 capital, that is called as preference shareholders capital. As we know that it is that portion of the fund generated by a banking company through issuing the preference shares. It is also known as the preference stock. So these preference shareholders have a first right to receive the dividend even before equity shareholders. Okay, whenever the profit has to be distributed among the shareholders, first priority given to the preference shareholders, and then whatever the money left out, whatever the profit left out after distributing the dividend to the preference shareholders, remaining can be distributed, or the same money can be retained in times of financial crunch. Okay, so that we call it as equity shareholders. Is that clear? Yeah. So let me introduce one more important capital of the banker. It is called as tier 2 capital. As I mentioned, it is a less secured capital. Number 1, subordinated debt. Okay, so it is this particular the capital, tier 2 capital. Okay, it is considered, it is less reliable, it is less secure. Why this particular capital is considered as less or unreliable security, unreliable stock, unreliable capital? Because it is more difficult to accurately calculate and to liquidate. Okay, because this tier 2 capital is very difficult to accurately calculate, and it is very difficult to measure, to calculate. That is the reason why we call it as tier 2 capital is less reliable or less secured. Yeah. So let's understand the components which comes under the tier 2 capital. Number 1 is subordinate debt. What's this particular subordinate debt? Subordinated debt or subordinated loan. So we can also consider it as subordinated bond. Correct? Subordinated bond. Okay. As I mentioned in the previous video, this tier 2 capital is a borrowed capital. Clear? Tier 1 capital is a owner's capital. That is why tier 1 capital is more secured, tier 2 capital is less reliable. Clear? Subordinate debt. Okay. Subordinate debt is known as junior debt. Okay. Subordinate debt is less secured. It is considered as junior debt. It represents a debt that holds a lower priority compared to other debts in the event of a company facing liquidation. If the company bankruptcy, in the process of bankruptcy, the low priority given to distribute the dividend, to distribute what is called the debt taken by the banker. By issuing some bonds or debentures, the bank has raised some capital. If the particular capital is considered as subordinate capital, because it is a junior debt, it is a junior capital. Because why this particular bond or debt is considered as subordinate debt? Because it is a junior debt. In times of liquidation, when the banker become bankrupt, in times of liquidation of a banker, the lower priority given to the such bond holders whenever the company is being liquidated and distribute whatever the money that has been accumulated by disposing all the capital, all the assets of the company, right? In times of liquidation of the company, the lower priority given to the debt instruments, the bond holders, and they comes under lower priority. Okay, the minimum original term of the debt is over 5 years. Okay, the minimum original term of this particular debt of a bank is over 5 years. So therefore, the lower priority has been given by the banker whenever the cash has to be distributed after disposing the bank assets at the time of liquidation. So that is the reason. Clear? Okay. So now, so let's move on to understand what is this revaluation reserves. Revaluation reserves. These are the reserves which are created by the revaluation of an asset. Revaluation reserves which are created by the bank by revaluing of the assets of the bank. That means a typical revaluation reserve is a building owned by a bank, right? Over time, the value of the real estate assets tend to increase. Take for example, the bank has a branch. Okay, bank has a branch in Indiranagar, Bangalore. Okay, bank has a branch in Indiranagar. It has a building. Indiranagar. Okay, so where the bank has its own building, right? It is an asset of the banker. Do you think over the period of time this particular real estate value will come down? No, highly impossible. So the value of the particular building which is located in a strategic place. Okay, so the value of this particular real estate keeps on increasing. As I mentioned, over time, the value of the real estate assets tend to increase and it has to be revalued. How do you do that? So, revaluation reserves can be done. Okay, so revaluation in the sense market value of the asset minus book value of the asset. Okay, in the books of account, the value of the particular real estate building, which can be shown 10 crores, but actual value of or actual market value of the particular the building of a bank, asset of the bank, is 20 crores. Okay, 20 minus 10 is 10. That is called as revaluation reserves. Okay, so revaluation of this particular reserve, why do the bankers will do? Okay, because this is the tier 2 capital, right? Okay, so one more important the component that we come across under the tier 2 capital is undisclosed or secret reserve. Only the financial institutions are eligible to do this. Okay, undisclosed or secret reserves, this particular thing can be done only by the financial institutions. This is not applicable to any other business houses. Only the banking business company, okay, banking company which has the right to show the financial undisclosed reserves. Okay, in general, reserve is shown on the balance sheet of the bank at the end of the accounting period. That we know very well. At the end of the accounting period, so in the balance sheet, Okay. So reserve can be shown. Reserve can be shown. But however, sometimes the banking company do not disclose their reserves in the balance sheet, which is known as secret asset. A kind of reserve whose existence is not disclosed in the bank balance sheet. Right? So this is, we call it as undisclosed reserves. Okay. The question arises, why do the banker will do this undisclosed reserves? Why the banker will not show, not disclosed such reserves in the balance sheet? Because to ensure a strong financial position of a banking company. Right? Why these undisclosed reserves? To ensure a strong financial position of the company. Right? To meet sudden financial expenses. So these are the two purposes for which the banker or banking company will do this. Okay. So different methods with which the bank will do this activity, that is called by showing excess depreciation on the fixed assets. Okay. By showing excess depreciation on the fixed assets, by undervaluation of the current asset, by undervaluation of current assets. These are the two methods. The different methods are there. These are the basic two methods with which, okay, the banker will do this exercise. Right? Okay. So thank you for listening. Have a nice day.